Welcome, dear traders. You are watching a recap of the Asian trade on April 10. Markets in Australia and in New Zealand are still closed on Monday for Easter holiday. So, stock markets are trading sluggishly today. Japanese stocks went up, and the yen also gained ground against the US dollar. Now let's discuss what trends are in progress in the second trading week of April. The major market catalyst last week was the US NonFarm Payrolls released on Friday. They signaled that the US labor market cooled down considerably in March. Monitoring the chart of the NonFarm Payrolls since the beginning of the year, the curve gives food for thought. Over the last 3 months, employment growth reached its peak in January when the US economy added 504,000 jobs. Employment declined to 326,000 jobs in February and down to 326,000 in March. All in all, the latest employment growth in the United States private sector was the lowest since December 2020. A weak labor market suggests the Fed's hawkish agenda. Interestingly, the NonFarm Payrolls locked a downtick in the unemployment rate to 3.5% in March from 3.6% in February. To sum up, the NonFarm Payrolls signal robust hiring, lower wage growth, and a historically low jobless rate. In the light of such mixed data, FedFunds futures shifted up by a percentage point. According to the FedWatch tool, the probability of a rate hike by 25 basis points is now measured at 61%. Meanwhile, market participants are looking forward to the US inflation data, which is due on Wednesday. Traders will look for clues to further policy moves of the Federal Reserve. Besides, the International Monetary Fund is holding its meeting this week. Earlier, the IMF predicted that the global economy would expand by a modest 3% this year. If so, it would be the weakest global GDP growth since 1990. IMF Managing Director Kristalina Georgieva said that major central banks aiming to curb soaring inflation dampened global economic growth, and the lending institution suggested that interest rates should not be raised at such a rapid pace after a long period of accommodative monetary policy. Nevertheless, some ECB officials dropped hints about another rate increase in May. As for the Federal Reserve, its speakers also warned a few times that the regulator was ready to raise interest rates until inflation is firmly brought down to the target level of 2%. This week, the US Fed will publish the minutes of the March policy meeting, which will shed light on further policy moves. By and large, the Federal Reserve is winding down its aggressive monetary tightening. The US dollar will lag this support in the second quarter of 2023, and the greenback will be discouraged if stock markets regain their risk-on mood. In the Asian session today, the greenback showed how it could behave in the medium-term future. Its index did not withstand the challenge and slipped to 102.10. The greenback tried to assert its strength today in the corridor between 102 and 102.30, responding to the NonFarm Payrolls. However, the grabbing yen landed a punch of the US dollar. Recently, the greenback has been on the defensive. The reason behind its volatility is US economic data, which has been mixed and unpredictable. Unlike the US currency, the Japanese yen looks more predictable. If the US inflation does not spring any surprise, the US dollar will be subdued against the yen. This scenario is realistic because of predictable actions of the Japanese central banks on interest rates. Today, new Bank of Japan's Governor Ueda Kazuo is making his inaugural speech. He is widely expected to maintain the previous setting of monetary policy, which has been pursued for 10 years by previous Governor Haruhiko Kuroda. According to the red-hot economic reports from Japan, the domestic economy is getting back on track. The Consumer Sentiment Index jumped to the highest level in 10 months since May 2022. Such economic conditions improve the yen's luster as a safe-haven asset. For the time being, the yen is winning favor with the investors and advancing against the US dollar in the corridor between 131.80 and 132.80. Notably, the yen buyers have been setting the tone for the third day in a row. The buyers of the dollar-yen pair broke 132.65, a one-month resistance, and pushed the price down to 132.10. While the yen was trading steadily, antipodine currencies were trading on a seesaw in the Asian session. The volatility was triggered by political jitters between Taiwan, the United States and China. On Saturday, China began three-day military drills, simulating precise strikes against Taiwan. The military exercises followed a brief visit of Taiwan's president to the United States. As Beijing is the key trade partner of Australia, the Aussie dollar is very sensitive to market moves in the United States. Hence, the Australian dollar is now making irregular fluctuations. As the chart shows, the AUD USD pair is making seesaw moves within the corridor between 0.6652 and 0.6677. Having incurred modest losses below 0.6700, the Aussie is trying to settle at about 0.6669. Nevertheless, the US inflation data proves a steady decline. The Australian dollar will extend its weakness against the US dollar. Amid escalation geopolitical tensions in the Asia-Pacific region, on a Monday, the New Zealand dollar is carrying on with its downward retracement from last week. The Kiwi sank to 0.6246 against its American rival from the earlier 7-week high. The Reserve Bank of New Zealand stated in the minutes of their latest policy meeting that inflation deceleration is in the cards. In other words, the regulator indicated a pause in the rate hikes or even a dovish reversal and a consequent rate cut. With such prospects, the NZD-USD pair traded mainly in the red between 0.6225 and 0.6258. You've watched the news of the Asian trade. Follow developments in the global financial markets on the InstaForex TV channel. Your feedback is highly appreciated. Good luck in trading and stay tuned.